So let's look at some journal entries for the perpetual inventory system. First, let's look at our T account for inventory. It is an asset. It's a short-term asset because you intend to sell your inventory in less than a year usually. So you start off with a beginning balance if you have any. And if you buy anything, right, then you're increasing your inventory with any purchases. And if you sell anything, then you're crediting your inventory to decrease it. And that gives you a final ending balance. All right, so let's look at some journal entries with this. Let's say we purchase $800 of inventory on account on September 22nd. So what do we get? We got inventory, so we're going to debit our inventory. And when we see on account, we know we're not paying in cash at that moment. We owe the money, so that is an account payable. All right, so that's your typical purchase journal entry. Now let's look at a sale for a minute. Oops, too far. Sold merchandise to a customer for $900 on October 1st. The cost of the merchandise was $600. Okay, so now just looking at this, you know you made $300 on the sale, right? But we don't actually journalize the $300. What we do is we record two pieces. Whenever you sell something, you have a two-part journal entry. The first part records the sale. So we're selling merchandise to a customer for $900. So we assume we got cash. So we increase our cash for the debit. And our credit is sales revenue. We made money. We made $900. All right. That records the sales piece of it. The second piece is to record the inventory part and the cost of goods sold. So the cost of the merchandise that we sold was $600. So we are going to, remember, expenses are like debits and cost of goods sold is like an expense. So we're going to debit cost of goods sold for $600 and we're going to reduce our inventory by $600 as well because we've just sold it. What you can see here is you can see the net of these two is going to be the $300. So whenever you're selling something, you have whenever you're selling merchandise or anything else, you usually have two parts. The cash sales revenue and the inventory part. All right. So, kind of wanted to show you. If you remember, this is not going to be pretty. I'm going to write on my screen. I'll record my terrible screen handwriting for all perpetuity. As soon as I can find there we go. All right. So if you think about it, turn my pen on. If you think about it, what you have is you've got, remember, it's sales revenue minus cost of goods sold gives you gross profit, right? So you've got sales revenue of $900, you've got cost of goods sold of $600, and it gives you gross profit of $300, right? So that $300 in profit is a result of those two transactions. Okay, let's move it along. Okay, I'm going to turn my pen off so I don't want to writing on the screen. Okay, so here's another try it. If you want to do this, do it on your own. Pause me, try it, and then come back. Okay, so here's the solution. Don't worry about the discount part at this point. All right, we'll worry about that in a second. All right, so let's talk about discounts. This is referred to as 210 net 30. And what that means is if you pay within 10 days, right? So we're selling people things. And we might offer them a discount. And the reason we might do that is because we want them to pay us, and then we want them to pay us quickly, right? So we might tell them, if you pay us our bill, we'll give you a 2% discount if you pay us within 10 days. But otherwise, no discount, and you'll pay us within 30. Like we want our money within 30 days. So these numbers could be anything. It could be 1, 15, and 45. It's whatever it is. So in this case, we're doing 210 net 30. So looking at this, is invoice paid within 10 days of the due date? Kind of made you a little flow chart here. Yes, then you get a 2% discount. If it's paid after that, no discount. Oh, I must have deleted the little. Oh, there we go. Somehow I have them order. No discount. Then we have to pay them the full amount in 30 days. Okay. So here's oh, that's why I'm doing this out of order. Okay. So if we have a 2% discount, let's go back for a second. Merchandise was purchased for $1,500 with credit terms of 210 net 30. Payment within 10 days is calculated as. Here we've got the invoice is $1,500, but we're not going to pay $1,500. We're paying $1,500 minus a 2% discount. That winds up being $30 on $1,500. So the dollar amount that we're actually going to receive is going to be $1,470 if they were paid within the credit period. If they don't pay us within 10 days, then they just owe us the full $1,500. Okay. All right, so let's get to some examples of that. SMB purchased $2,000 merchandise from its supplier on account terms 315 net 45. Well, we're buying stuff now, right? When we're making the purchase, we're buying $2,000 worth of merchandise that we're going to turn around and sell in our store. When we're buying it, we have these terms, but we're not paying them yet. We don't know if we're going to pay within 15 days. So we don't know if we're going to take a 3% discount. So what we'll do is we will record the inventory at its full amount of $2,000, and we'll record the liability accounts payable for $2,000. Okay? That's all that happens when you first make the purchase. And then maybe we decide we didn't want $100 worth of merchandise because it was damaged. Oh, actually, hang on 1 second. Let's record these in my T accounts because it helps to keep track of these things. So we've got our debit to merchandise inventory and our credit to accounts payable here. Okay, that's where we stand. Now let's return $100 worth of merchandise, okay? I mean, which happens all the time. Things are broken, things are damaged, it happens. So if that's the case and we're sending $100 back, we will reduce the liability by $100 because we're not buying the stuff. And we're going to return that inventory that was damaged. So we will update our accounts accordingly, our debit to accounts payable and credit to merchandise inventory. All right, so now let's pay. We now have to pay the people. The thing is we're going to pay them minus this return that we have. So really we've got $1,900 that we owe these people at this point. But we are going to pay within the discount period. We're going for that 3% discount. So let's first calculate the discount. It's 3% on $1,900 because that's what we currently owe, right? It's $2,000 minus what we returned. That is a $57 discount. So when we write a check and mail it to them or send them to them, however, electronically, we're not going to give them $1,900. We're going to give them $1,900 minus the $57. Our total is going to be $1,843. So let's look at the journal entry for that. We are going to reduce our cash because that's the bill we have to pay. Like I said, when you can start with cash, start with cash. It's helpful. At least you have part of the entry. So credit cash, $1,843. We're going to reduce the liability, accounts payable, but we're going to take away the full $1,900. And the reason we do that is if you thought about it, and if we just debited $1,843 here, and you had $1,900 credit and $1,843 debit, it's going to look like you still owe them $57 because it will never clear out. That's not what you want. So we're going to debit it for its full amount of $1,900. And then what do we do with this last $57 though? Because right now we don't balance. Well, that last $57 is going to actually reduce your merchandise inventory. All right, now why? Well, let's go back for a second. Let's see. Do I have any? Okay. We're going to reduce it. Here we go. 57, 1843. Let's go back for a second. Think about way back when we had the historical cost principle, like 2 weeks ago. The historical cost principle, right, said that you need to record an asset for what you paid for it, right? Record anything for what you paid for it. So if that's the case, you didn't pay $1,900 for that inventory. You paid $1,843 for that inventory, right? So we're going to reduce the inventory by the discount, and the inventory will be properly recorded at the actual amount of cash that we spent. Makes sense? All right. So I'm going to pause here. We're going to go on to the next one because freight terms is going to take a minute.